Welcome back. Crude had surged to $120 billion this morning, 88 and now $94 per barrel. What does all this mean? Here's one plate we got from the State Bank of India research, which says that if crude in FY27 averaged $90 per barrel, then the inflation goes up from their old estimate of about 3.7 to 3.9. GDP falls to 6.8. And as you can see, 100. The moment crude goes above 100, at $120, CPI shoots up to 4.8% and GDP comes down to almost close to 6%, 6.2. Well, these are various estimates that are coming. Let's get to top-notch economists to tell us what they make of the possibility of the impact on Indian macros. Joining me now are Upasana Bharadwaj, the Chief Economist at Kotak Mahindra Bank, and Aditi Nayar, the Chief Economist at ICRA. Ladies, thank you very much indeed for your time. Aditi, I just got your report as well. But if you can take us through what your fears are. We have to assume that crude may not be 100, but the average for FY27 could be 90 perhaps, if the risk premium continues. What is the impact on various Indian macros?
Thank you, Lata, and you're certainly right. Even though like $100 or $125 per barrel may have been an extreme case that we have put out in our report just to put out the numbers, but certainly crude oil could end up averaging a fair bit higher in FY27 than our baseline estimate, which was $70 to $75 per barrel. Now, in terms of the macros, all of them will get impacted by different degrees. To start with, the net oil import bill, for every $10 that the average crude oil price increases in FY27, the net oil import bill would go up by 14 to 16 billion, and therefore the impact on the CAD would be 30 to 40 basis points. And of course, this would have an impact on the currency. In terms of inflation trends, it would depend on what is the extent to which pump prices are revised. But for the WPI, where generally transmission tends to be quicker and more complete, we would expect that for every 10% increase in crude oil prices, the WPI average would go up by 80 to 100 basis points, and our baseline for this year was 2.7%. For the CPI, here the extent of transmission to the RSPs is extremely important. If there is full transmission, which is not at all the base case, we would expect that the CPI would go up by 40 to 60 basis points for every 10% increase in the average crude oil price. But I'm again stressing that is not our base case, that there will be a full transmission. And our base case for the CPI inflation for FY27 is 4%, so any increase would be over that.
Okay, I get your point. Upasana, now for the more tough question. I mean, these are scenarios we can build. But at the moment, we have a sentimental pressure on the rupee. We started off at 91 in the morning on news that, the crude prices have fallen because of some Donald Trump statements. But the rupee is back again at 92.15. So realistically, should we be prepared for some worsening of macros, not to the extent of $90 and $100, but are we in for higher fiscal deficit, higher current account deficit, and lower growth in FY27?
Ilata, let's look at the numbers that we're talking about as on 27th of February, the Friday for which this entire thing started. Crude oil prices were around $70 a barrel, plus minus here and there. Today we are still $24 higher. Even though we are lower than the worst that we've seen recently, but it is still higher. Now the point is, how low does it go from here? So clearly our base case of $65 a barrel, which still remains for now, of course, but there is an upside to that. And as Aditi pointed out, for every $10 increase, there will be pressure on our macros. So if we settle, if the risk premia to our crude oil prices do not come back to $65 a barrel or plus minus here and there, then clearly there is an upside to the risks are there to our macros there. And we do see some kind of an issue there. And as you mentioned for rupee, clearly the belief that this war is, we have seen a lot of volatility around this. We are kind of held ransom to the tweets that come overnight. At the moment, I think the markets do not fully believe what is there. Nothing on reality has changed for the moment. So I guess in the near term, sentiment will remain a little wobbly. As a result, we may not see too much respite on the rupee front.
Okay. Let's drill it down to markets. At the moment, would you say that the chances of a rate cut henceforth are completely gone? Or would you pencil in even a possibility of a rate hike or at least a yield hike for banks?
The question is to me, Lata?
Yes, Upasana. To the banker here.
Clearly, I think if these issues were to persist, then the possibility also, if it existed, for a rate cut is now out of the picture. I don't still see that the rate hike probability should go up right away. As I said, it's a volatile situation. We will have to wait and watch that if this crisis was to last at least for 2-3 months, that's where the probability will increase significantly.
One minute, Upasana. Maybe I messed up the sentence. A rate hike may not be there because we are now talking about 4% CPI even with an increase in pump prices. What I'm asking is whether yields will go up. What are banks sensing because of this upward pressure of prices?
Yeah, so there are two things to be kept in mind. I think one is how aggressive RBI has been in the recent days in terms of the OMO purchases.
Yeah.
Of course, the 1 lakh crore has been announced, but apart from that, even in the secondary market, RBI has been very aggressively buying bonds. Now, that is something which has really supported the bond market sentiment. More so at a time in March when auctions are done with. So the supply of GSEC is not there. Now going ahead, if this problem was to persist, obviously there will be a fiscal pressure. Bond markets will further come under pressure and the balance of payment too will start getting deteriorated from here. So the need for RBI to act more aggressively will also be there. So there will be upside to yields, but probably it will be to an extent capped also by RBI presence.
Okay. Aditi, since Upasana spoke about fisc, and I wanted to come to you on that, are you distinctly seeing a higher fiscal deficit, not just this year? This year it is because of the arithmetic. The nominal GDP has come down. But next year, there will be probably lower dividends from oil marketing companies, as you point out in your report. So, if the earnings are less for the fisc, do you expect actually higher borrowing? Not just a percentage fiscal deficit, but actually total borrowing going up?
Lata, the way we see it for the remnants of FY26, but mainly for FY27, the three key areas where the fisc will get impacted will be the fertilizer subsidy, because the imports going into fertilizer prices, I mean, that is definitely something that we're very watchful of and very wary of the way the things are moving. Second is the overall impact on the dividends that the oil marketing companies would be able to give to the government of India. And here again, the average crude oil price and the marketing margins for petrol and diesel, the retail sales prices, all of this will matter in terms of the impact on the fiscal math. And the third is overall what will be the impact on corporate profitability, because that will impact the tax revenue collections of the government of India. So between these three things, as of now, see, the nominal GDP issue has an impact on the fiscal deficit and borrowings as a percentage of GDP. But these three factors that I'm talking about have an impact on the fiscal deficit at an absolute level. And that is something that for FY27, the extent that the conflict prolongs and the extent to which the availability and the prices of natural gas and crude oil, etc. get impacted, that is going to have a key bearing on how the fiscal plays out, especially in the first half of FY27, for instance.
Yeah.
Now, in terms of FY27 borrowings, because we've seen a lot of conversions, etc. happening, the pressure that was felt on 1st of February in terms of the gross borrowing, that has eased off quite a bit. But obviously, the net borrowing number will now get impacted by the state of the fisc going forward. And for FY28, anyways, the pace...
So will there be borrowing? I just want that answer. Are you expecting higher net borrowing in FY27?
If the crude oil prices go up by, let's say, $10 per barrel on average, then yes, it would have some impact on borrowing.
Possible. Upasana, what about currency? What are your internal numbers now? Do we see 93 in a quarter, 94 in 12 months or 6 months?
Well, Lata, again, it's a scenario analysis we are all working with. But yes, if this problem was to persist, then clearly I think we could see a shift towards 93 to 95 range. Again, it's all about how long this problem persists. If within March we do see everything settle down, then I think we'll be back to where we were, a 90-92 range. But I do assign a reasonable probability that the first quarter also could see a 93 to 95 range, purely because the spillovers of the crisis and the kind of disruptions that it may cause may not settle down immediately. So I guess we might be seeing some kind of a persistent pressure even into first quarter. That is the reason I think we could see a shift towards 93 to 95 range.
Okay. Well, I might just end with a arithmetic salve for all this. If WPI and CPI were to go up a bit, then somebody in government told me that also means nominal GDP will go up. And that will mean, we can manage the fiscal deficit, borrow a little more without really disturbing the fiscal deficit number. Well, these are small consolations. We have to wait to see where everything settles down. Thank you very much for setting us thinking on what we should worry about. Upasana and Aditi, thank you for joining. Wrap up on Bazaar. Chat